Hello, beautiful people, and welcome to another brand new edition of the ITU Forex class. In this week's episode, we're actually going to be talking about how to build confidence in your trading. Okay, and this is the reason why I thought about talking about this particular topic in this week's episode is simply because a lot of traders don't actually have this. Okay, so they just simply think that trading is a business of buying and selling, and so whenever they place a trade, they just, whenever they see a price movement on the charts or something, they simply just buy and sell. But when they move past that initial, that initial newbie stage, trading moves from something that's enjoyable and fun or exciting to something that's downright scary. Now, let me explain why. So when they first get started, okay, at that beginning stage, at that initial stage, they usually, learn a thing or two about trading. What is a pip? How do traders make money? All of those basic stuffs, okay? And usually at that point in time, if you're doing it the right way, then you haven't invested money into a trading account and started trading because you probably you don't even know anything about it. Talk more of having a trading strategy that has a proven edge over the market. Okay, so at that stage, trading is exciting because you're learning a new thing. You're learning about the definition, the terms of trading. What is a pip? What is spreads? What are commissions? How to place the trades, and all of those things. So at that point, trading is not threatening. Trading is not scary or anything like that. But then after they move past that initial stage, and then they reach the stage of actually trading, okay, placing trades through a trading account with a broker or prop firm or anything or any trading platform, and then real money gets involved, this is when trading starts to change for them, especially if they don't know what they're doing and if they've not been mentored by a professional. So this is where trading turns from something that's enjoyable to something that's downright stressful and scary and all of the negative things you could think of. The reason being, when they first got involved with trading, they were only learning the basics and they were not, real money was not involved. So they were not placing any trades. They were not experiencing losses or winning trades or losing streaks or winning streaks or anything like that. That was almost inexistent at that point. But then when they moved from that initial stage to actually placing trades through a trading account, if they didn't do it the right way, which is after learning the basics, getting a trading edge, testing it out, back testing it testing it on a live account, doing all of the things, the groundwork they need to do to lay a solid foundation for their trading. If they skip all of that and then they just move on to funding an account and trading it with money that they can't afford to lose, then trading starts to get really, really stressful. Because let's assume they fund the account with like $1,000, okay, which is in the world of trading, $1,000 is nothing, okay. But let's say this is money that they've spent years saving, and this is money that they actually can't afford to lose. What I mean by they can't afford to lose is, let's just try to reframe it in such a way that this particular $1,000 is, let's say, their rent money or their car payments or anything like that, and so they actually invested that money into their trading account with the thoughts of doubling it or tripling it or whatever, and then taking out the initial investment and just with a little bit of profit and just continuing to trade, which is not a bad thing, but that's just not how trading works. But in any case, they never ever brought it to the forefront of their mind, that there's a possibility that they could lose that money that they've funded their trading account with. And so when they fund that account and they start placing trades, and then they start taking losses, which is inevitable in trading. Everybody knows that, even the professionals, okay? And then they start taking losing trades. Now trading starts to get scary because if, for example, they were trying to double the account as fast as possible, and so they ignored the advice that we give traders, which is to risk no more than 1% of their trading account's capital on each trade they take. And they start risking something like 10% of their trading account's capital because they want to quickly double that money. And it so happens that the first 4 or 5 trades that they take all turn out to be losing trades. Now their account has gone from $1,000 to being negative like $400 or so. And so they're about 40% down or 50% down if they took like 4 or 5 losing trades in a row. And so now it's getting very scary, because the reality of them not being able to, make back what they've lost and then make extra on top to withdraw is now starting to get very real. Now they're starting to worry about, okay, how am I going to pay my rent, because it looks like I've already blown this money, or how am I going to make my car payments or anything like that. And so trading with confidence completely gets out of the window at that point in time. You don't even want to think about trading with confidence. You just want to trade in such a way that you're not going to get scared for your life or scared for your well-being. Okay? And so that's one of the reasons why I want to talk about this week's topic, which is trading with confidence, because a lot of newbie traders, especially the ones who just learned, trading on YouTube or, not through the proper channel. The proper channel in this sense is going through trading with a mentor that's made the mistakes, or, a trading community that will guide you every step to doing the right thing. Okay? Especially if you do that, just learning bits and bobs from here and there and all of that, then trading with confidence might be something completely alien to you. Okay? So let's talk about it. Okay? Now that we've talked about the groundwork, what is confidence in trading? Because confidence in trading might be completely different to what you think confidence should be in anything else. Now, just like you've seen me written here, confidence in trading is actually trusting your process and not hoping for outcomes. What does that mean? Let's say you have a trading strategy which you've backtested. Okay? After backtesting that trading strategy, you took like a couple hundred trades with it. And so now that you've backtested that trading strategy, you actually have data on how the trading strategy performs. Now, if it turns out that that particular trading strategy is a profitable trading strategy, okay, from your backtest, you took a couple hundred trades with it, and the backtest shows you that this trading strategy is a winning trading strategy. And let's say out of the 100 trades you took, you only won 40% of them. But because you were risking much less than you were making on average, eventually the profits you made from your tiny 40% winning trades, that's like 40 trades out of the 100 you took, they were more than enough to cover for the losses you incurred and also give you extra profits in the process. Now, in this case, you have data showing you clearly that that trading strategy works. Okay? Now, apart from that, the next thing is, now you know that this trading strategy, the way it works is it lost more trades than it won, but it still ended up making me money because I practiced proper risk management. I had the right risk to reward ratios. If these are things that are completely new to you, you can watch other videos on the channel, which we've talked about, risk management, risk to reward ratios, and all of that, keeping risk consistent and everything. Okay. So let's say you've seen firsthand that you don't need to win all of the trades you take to be profitable. Now, you also have another thing, because as you were taking those trades with your trading strategy, you must have seen that there were points in time where you had like 4 or 5 or 6 or however many losing trades in a row. And the trading strategy still ended up getting out of drawdown or crawling out of drawdown and still giving you profits in the end. Now, with that knowledge, this is going to help you to build a trust in your trading process, your trading edge, your trading strategy. So if, for example, this is just an example to illustrate my point, okay? If, for example, the trading strategy you used was a break and retest trading strategy, and you took a couple hundred trades with it when you were testing it, what is the usual break and retest? It's usually, price makes a high and a low, market structure 101, okay? A high and a low, and it continues doing this for as long as the trend continues, okay? So let's assume what we have here is what we talked about in last week's session, okay? So we've got price making higher highs and higher lows. We're definitely in an uptrend. And then out of the blue, price just makes this low. And then when it made this low, we had liquidity being taken out. So after this liquidity was taken out, let's say you're following what we did last week, okay? Because I'm just trying to build on what we've learned, okay? And so after you saw this, you took a trade somewhere around here, your stop loss being below the liquidity zone, which was just swept, okay, somewhere around here. And then you're aiming for a 1:3 risk to reward ratio, or 1:2, or whatever the case might be. Okay, let's just say 1:3. You can see that price would have easily hit your profit target in this case. Now, when price did this, this was a winning trade. So if you risked 1%, you ended up making 3%. Okay, now let's say you did this about 100 times. You took about 100 trades with your backtest, but lo and behold, it's not every single one of those 100 trades that you took that were winning trades. In fact, if you're trading with a risk to reward ratio like 1:3, more often than not, your win rate is usually going to be much lower, something like 40%. Okay, so because of this, there are going to be points in times where you're going to have clusters of winning trades. That's what we call a winning streak, or clusters of losing trades. That's what we call a losing streak. Now, when you see this happen in real time after taking trades in a backtest environment or in a simulation environment or a demo trading environment or whatever the case might be, this will cause you to have trust in your trading strategy. And so now, instead of whenever you place a trade, you're crossing your fingers and hoping that that trade turns into a winning trade. Okay? That trade goes from your entry to your profit target. Instead of doing that, now you will not bother at all about the outcome of the trades. Because when you take a trade, you don't care whether that trade goes to hit your profit target or it goes to hit your stop loss. Because at the end of the day, you know that you've trusted your process in such a way that you know that after taking like 100 trades, eventually your numbers are going to play out, and so you're going to end up making more money from your winning trades than the money you would lose from your losing trades, even if that losing trades are more than half of the number of trades you take. And so this would make you trust your process. And what is your process? Your process is your trade entry strategy, your trade entry process, how you identify trade entries. So for this particular example, we said we wait for a market structure, higher highs and higher lows, and then we wait for liquidity sweeps, then we place a buy entry. And our process, the second one, is the stop loss identification process. We place our stop losses below swing points, and then we aim for a fixed risk to reward ratio of like 1:3. This is our exit process. And then we have a process also for our risk management, which is we don't risk more than 1% of our account's capital on any trade we take. So instead of you just taking a trade and then hoping that, oh, please, I need this trade to hit profit target, or, oh, please, this trade shouldn't hit my stop loss, you're not even going to care. Because you know that at the end of the day, if you follow your process, which is to wait for market structure to manifest itself, and then you wait for your entry rules to be met, and your stop loss rules, you respect it, your exit rules for your take profit, you also respect that, and your risk management rules, you know that if you just keep doing this over and over and over again, whether the trade you take now is a winning trade or it turns out to be a losing trade, it doesn't matter. Because at the end of the day, after you take a large number of trades with it, this is what we call the law of large numbers. After you take a large number of trades with it, eventually you would end up becoming profitable. So you now trust the process. That's what we're talking about. And so, just so we're clear, what I'm saying is, because this particular method, or whatever method you decide to trade with, as long as it has an edge over the market, and you do what you're supposed to do as a trader, which is your due diligence to confirm that the trading strategy you're trading with is actually profitable. It's not like somebody just handed it to you and you don't know if it's actually profitable because you haven't tested it. You don't have quantifiable data to prove that it's actually profitable. Then if you haven't done this work, you can't trust your trading strategy. But if you've done the work and you've taken hundreds of trades in the past, then now you have data which you can look back on and see that, okay, yes, this trading strategy is actually profitable. I've seen it. It's proven. Okay? And so this will help you to trust it. Now, this is an example we just talked about. How do you do this in practice? The way you do this is simple. Okay? The way you do this is simple. Let's take a look. Let's take a couple of example trades so that we really drive home the point. Okay? So now, what do we have here? What we have here is, you can see that price is in a downtrend. Price made this low. This is the market structure of a downtrending market. It made a low here, and then it made a high. But this high is not as high as the previous low, and so this is a lower high. And then eventually it made another low. This low is lower than this previous low, so this is a lower low. But then instead of price respecting this lower high and forming another lower high and then breaking below this low to form a lower low to continue moving in the downtrending market structure, it failed to do that. And so out of the blue, price now, instead of respecting this low, it didn't, this lower high. It broke above it. Okay, and so now we've shifted from making the market structure of an uptrend, a downtrending market, to making the market structure of an uptrending market, which is price is now breaking above highs and it's forming higher lows. It's breaking above highs and it's forming higher lows. Okay, so the market structure has just shifted. Now you can see out of the blue, price just broke above this resistance. Now you see it's forming higher highs and higher lows. Okay, and let's say you've seen this. After seeing this, you can see that price now came around here and it broke above this. You can see this is the trade setup that we talked about. Okay, where price broke above the low, retested the area, swept liquidity, and it moved up. Why am I showing you this? The reason why I'm showing you this is because if you take a couple of charts, open up a couple of charts and you revisit them, and before you open the charts, obviously you must have written down the trade entry rules. Okay, what needs to happen before you identify a trade entry and take it, and what you need to, where you're going to place your stop loss for your exit if trades don't move in favor of your trading position. Where are you going to get out with your loss, and where are you going to get out with your profit? So if you're using a fixed risk reward ratio like 1:3, which is the type we used in this example, where are you going to exit with your profits, and how much are you going to risk? All of those things. If you've outlined all of those things, the next thing you need to do is, if you have a simulator like Soft for FX, which is not going to show you the future price action, you're just going to go to the past and then you're going to play it realistically, just like you would in the normal market, okay, which you're not going to have data to see, okay, the future, then that's even much better. Just go out there, start trading from like 2015, 2018, 20, whatever the year you choose, and then test your trading strategy. Take trades, 1, 2, 3, 4, 5, take hundreds of trades. That will help you to build confidence in your trading strategy. But if you've not done this, whatever I'm going to tell you is going to be, sound just kind of alien to you, because it's one thing to actually trade with a trading strategy and see that it is profitable in real time, and it's a completely different thing for somebody to just come and give you a trading strategy and tell you this is a profitable strategy. The reason is because if you traded this trading strategy, whether it be on a live account or a demo account or simulation account, and taken hundreds of trades with it, that will show you firsthand that trading strategy is a profitable trading strategy. But if you've not done this work, and somebody out of the blue just comes and gives you a trading strategy and tells you that it's profitable, let's assume that you agree with that person and you go and start trading with that trading strategy. And so you take one trade with it and it's a winning trade, you're happy. You take the second one, it's a winning trade, you're happy. And now, because you don't know that trading strategy, having like 5 or 6 losing trades in a row is a normal thing for that trading strategy, you now got overconfident because of the 2 winning trades you took. And so instead of continuing risking 1% of your account's capital per every trade you take, you now start risking 10%, for example. And then the moment you risk that 10%, you took a trade that turned out to be a losing trade. And not just that, now you're angry because you want to make back the 10% that you lost. Okay, and you want to make back even whatever you lost before that 10%. Or, okay, you didn't have losing trades, so obviously you wanted to make extra profit. So let's say instead of continuing to risk 1% of your trading account's capital, you just can't get yourself to do it because you feel, if I'm risking 1%, how many trades will I have to win to make back this 10% that I just lost unnecessarily? So you might want to make it very fast, and so you decide to risk maybe 15%. And then you take another loss with that 15% loss. Now, instead of your account to be in profits, you are down bad. And so you keep doing this and you keep doing, and this is all because you didn't test this trading strategy and see its capability in real time. Let me show you an example, okay? This is a trading strategy that I use to trade the markets. I've talked about this trading strategy countless times on the classes in this video, okay, on this channel, okay? You can see that the way the strategy works is I use the higher time frames to identify the direction of a trend, and then I use the lower time frames to take entries in the direction of that trend. So if the direction of the trend is bullish on the higher time frames, and I've established that, I will now come to the lower time frames to look for long trade setups. Now you can see that currently I'm in a trading position. Okay, where is the toolbox? Let me quickly find it and open it. Yeah, here. You can see that I'm currently in a winning trade. But even before then, when we go to the history, you can see that the trade I took was a winning trade. Because this trading strategy, like I told you, I've been trading this trading strategy for years and it's been very, very profitable. It makes money. And it might surprise you to know that this trading strategy has a win rate of only around 40%. So I even lose trades more times than I win. But simply because the trading strategy gives me profit, more profits on the winning trades that I take than the losses I take on my losing trades, I still end up making profits with it. Now, to show you how the strategy works, you can see that this is the daily time frame. How do I determine the direction of the trend? The way I do it is I wait for price to either cross and close below all of these three moving averages. So in this case, when this big red candle closed below here, this would have told me that the direction of the trend has switched from being up to now being down. But then you can see immediately the next couple of days, price also crossed and closed above these moving averages again. So the trend has moved from downtrending to uptrending. Now this is for the daily time frame. When I see that price has crossed and closed above the three moving averages on the daily time frame, what I want to see is the 4-hour time frame is also showing me that price is in an uptrend. And the way it does that is I want price on the 4-hour time frame to also cross and close above these moving averages. Okay, and this is what I had. I'm building the case for why I took this trade setup. That's what I'm trying to do for you here. Okay, how this strategy works. What I'm trying to tell you here. So now, after I've established that the direction of the trend is bullish on both the daily time frame and the 4-hour time frame, because price is trading above the moving averages, then I'll now move down to the 1-hour time frame to identify my trade entry setups. How do I do that? You can see that on the 1-hour time frame, I have these things that look like arrows. Up arrows, down arrows. Okay, what do? They just show me swing points in the market. Okay, and so whenever I identify the direction of the trend on the daily time frame and confirm the direction of that trend on the 4-hour time frame, on the 1-hour time frame, I want to identify these swing points after price has crossed and closed above the moving averages. So in this case, you can see that price has crossed and closed above this moving average, and I took this trade here. My stop loss would have been somewhere here, and this is where I placed it. And the way I trade using this trading strategy is I scale out of trading positions. What do I mean by scale out? Some traders, and there's no right or wrong way, it's just the way you like doing things and the way you've tested over time and seen that it's profitable. That's just the way you do your things. Okay, so what I've found is whenever I take a trade and I find that after I take that trade, price hits my profit target and then it just continues moving in my direction, which is common, which is a normal thing during trending market conditions, that tends to get me to be indisciplined. Because when I take a trade and I'm risking 1% and I have my stop loss and my take profit, but the price hits my take profit and then it keeps moving for 5 hours, 10 hours or whatever, I just keep sitting down in regret, thinking if only I didn't close this trade, I would have made so much more. So what I did was I devised a plan to close some of my trading position when price hits my predefined profit target and then move my stop loss to break even, so that if price continues moving in my favor, I still have a portion of my trade in the market so that I can capitalize on that move. So you can see that I take 2 trading positions. If I'm risking 1% of my capital on any trade I take, on one portion of the trade, which has the profit target, I'm going to be risking 80% of that 1%. So if my risk per trade is $1,000, because this is a $100,000 account, I'll be risking $800 on a trade which will have the stop loss and the take profit, so that if I'm risking $800 on that particular portion of the trade, my take profit for that trade will be around $1,600. But then on the remaining 20% of the position, because when you add $800 and $200, you have $1,000. On that remaining portion of the trade, I'm not going to have a profit target. The idea is I'll let price to keep moving, and then I'll capitalize on it, and I'll only close that trade either when price comes back to my trade entry level and takes me out for break even, which means I didn't lose anything on the position and I didn't make anything on it, or price crosses and close below this moving averages on the 1 hour time frame. That's when I'll close this trade. So in this case, you can see that this worked out, because on the 80% of the position, my risk per trade position which I took, you can see that price ended up hitting my profit target, and so this trade ended up being a winning trade. And so I moved the stop loss on the open trade, the remaining 20% position, from the initial position which is somewhere here, to break even. So now even if price comes back down here, I'm not going to lose anything on this trade. But if it continues moving in my favor, I'm going to make a profit from this trade. Now, why am I showing you this? This is because I have my trading process outlined crystal clear. So now that I have it outlined crystal clear, it's easier for me to go back in time through a simulator or anything, backtesting software or something like that, to test if this particular strategy or this particular approach to trading would have made me profits. And I've done that. I've seen that after taking hundreds of trades, this particular method is actually profitable. And I've traded with this method and it's made me profits. I've passed prop firm challenges with it. I've made payouts with this. This strategy, it actually works. But if I was to just give you, which is what I'm doing in this class, if I was just to show you that, okay, this trading strategy works, and then I let you go and take trades with it, then you might find it difficult to use it. Why? The reason is because you've probably not put in the work. And so when I teach you this strategy now, and you go and take a trade with it, and you end up taking a losing trade, okay, that's normal. Take the second trade after that, another losing trade. The third one after that, you now start doubting, maybe I just lied to you. And that's not the case. The reason is because, like I told you, after taking hundreds of trades with this trading strategy, in fact, the trades that I win are more than the trades that I lose. So I'm only right about 40% of the time. But because I practice proper risk management, even though I'm only right, less than half the time, I still end up making profits because my winning trades are much larger than my losing trades on average. So for you to gain the kind of confidence or trust that I have in this trading strategy, for you to have that for yourself, you also need to do what I've done, which is go back in time, test this trading strategy, see for yourself that it works. See the times when you'd have like 4, 5, 6, 7 losing trades in a row. And then see also the time when you have like 4, 5, 6, 7 winning trades in a row. How you would have made profits with all of these things. If you don't do this, you can't build confidence in the trading strategy. Whichever one it is, not even just this one. So if you want to trade with confidence in such a way that whenever you place a trade, you don't care if that trade hits your take profit or it hits your stop loss, you need to do the work. You need to put in the groundwork. And what is that groundwork? The groundwork is to develop the edge, clearly outline your rules, and then go back in time and test it. So this is just it, okay? If you want to trade in such a way that you're not going to be bothered by, okay, no, this was a winning trade or this was a losing trade, or you need to do the groundwork. And the groundwork is testing. Test that trading strategy. Prove that it works before deploying it to the live markets. So this pretty much brings us to the end of this week's edition of the class. But before we wrap up, I would like to use this opportunity to tell you guys about our bots, which are robots or trading expert advisors, which are designed to do this work for you, okay? These methods that we're teaching you are methods which you need to be in front of the charts, place the trades, do all of these things by yourself. But if you're using our bots, they're actually going to identify the trade setups for you, do the proper risk management for you, place the trades for you, even when you're away from your computer, okay? So if you're interested in taking advantage of any of them, or if you're interested in starting to earn some money through trading while you're learning, then please reach out to us on any of our social handles, and then we'll be more than happy to assist you, walk you through how to set everything up and get up and running in no time. Start earning while you're learning how to trade manually, okay? So you can have a portfolio of your investment with manual dedicated to manual trading, and another portfolio dedicated to automated trading. Diversify, okay? That's what you should do. So if you're interested in it, please reach out to us on any of the social handles, and we'll be more than happy to assist you set everything up. Once again, thank you for taking time out of your busy schedule to come to this class. I look forward to seeing you guys in next week's edition. May God bless you. Have a wonderful rest of your week, and cheers.